One of the things that we've talked in the past, and one of the things that I found so interesting in those conversations is that, when you're in the stock market world, real
Yep.
estate, from the perspective of an investor, gets a really bad name. And it's based largely on Robert Schiller, who's a professor at Yale, his observation that, over the last 100 years, on an inflation adjusted basis, like real estate, and I think he's talking specifically about current residential real estate, has appreciated something like 1%. I don't know the exact percentages, but I mean, we're talking in basis points, not like 100%. But there's really more to the story than this, isn't there? Specifically, if you buy, say, a second house with a mortgage, your return, assuming it's leased out, is going to be more along the lines of 6%, right? Like your mortgage plus presumably some type of small premium. Can you dig into this a little bit and kind of
Yeah, and
dispel
so
this notion that,
I'll give you an example. You just consider my daughter bought a house. She bought it to live in it. Then she, fell in love and moved in with her boyfriend. She paid a couple of $100,000 for the house. Her house payment's $1,200 a month. She collects $1,450. So right there, she's making cash flow. And so you would measure her return based on the cash flow compared to her investment. And her investment wasn't the $200,000 she paid. In her case, I think she paid $10,000 down. So coming out of the gate, she's making $3,000 in cash flow against that $10,000 investment. I mean, that's not bad. Her house is probably going to appreciate in our market, even as bad as it is. Probably it's really going to go up probably 2% a year. That's another $300 and something a month, and then she gets the tax benefit of depreciation, and that's probably another $350 a month. And so, you add those three elements: the cash flow, the appreciation, and the depreciation, which are real benefits that you get. She's probably making somewhere around $900 a month in value.
And then, of course, and then over the course of that, so she puts 10,000 down. Presumably, she holds that. It's a conventional mortgage, 30-year mortgage. She holds that for that entire 30 years. Assuming on an inflation-adjusted basis, it still appreciates. But let's say it even stays even. You're still looking at a not illegitimate return, right? I mean, you're not looking at a zero return. It's because you're not just looking at the appreciation. What you're saying is that you have that appreciation, but you also have the depreciation, and you also have the cash flow, and you put those three elements together.
Sure. We'll just go back and just say one of the things I didn't mention was the amortization of the loan. So let's just say in this case, pick a number, doesn't matter. Say the amortization is $150 a month on this loan to begin with. Over time, somebody else is going to buy that property for her. That's a huge benefit. So that $150 amortization for a stock investor buying a mutual fund on a dollar cost average basis, I mean, there's a $150 deposit going into a mutual fund. It's the same equivalent, except that they have the other benefits that we just talked about: cash flow, depreciation, and appreciation. So, I get a kick out of folks who want to debunk real estate as investment. I've owned stocks for my own account. I own high flyers and I owned low flyers. I've never known real estate to go to zero because there's intrinsic value to the physical asset, to the tangible asset. And so, real estate in my mind is a great investment. And one of the things that people used to, always say it was not a good investment because it was highly illiquid. And I would say, to the contrary, real estate can be highly liquid with a simple credit line that's attached to the property. So you could literally write a check for whatever cash you have in terms of the equity. So I think, John, one of my philosophies has always been if you want to beat the statistical average, which says that, when you reach retirement age, you're either dead or dead broke. I mean, simply to beat that average, I've always said you buy one house, pay for it, that's the one you live in. You buy a second house, you pay for it, and that provides you with money every month. And if you just do those two things and forget about everything else, I would argue you're probably, in the top, 5 percentile of all savers and investors at retirement.